Navitas Semiconductor Corp, listed on the NASDAQ under the ticker NVTS, is currently in a state of quiet as of today, Monday, January 19, 2026. The United States equity markets are closed in observance of Martin Luther King Jr. Day, meaning no live trading is occurring at this second. However, looking at the tape from the final session on Friday, January 16, 2026, the stock made a massive statement, closing at $10.91 USD. This was a significant intraday surge of 0.91 USD, or approximately 9.10%. In the after-hours session, the enthusiasm continued with a slight additional tick upward to $10.96 USD, a gain of about 0.46%. While a nearly 10% jump in a single day is enough to get any investor's blood pumping, the story here is much deeper than a simple technical breakout. Most people looking at this price action are likely attributing it to a general rally in the semiconductor sector. But here is the real insight that hasn't fully circulated through the retail grapevine yet. Just 4 days ago, during the Needham Growth Conference, a bombshell development was confirmed. NVIDIA has officially named Navitas Semiconductor as a core supply partner for its next-generation 800-volt DC power architecture, specifically designed for AI data centers. This isn't just a minor contract, it is a fundamental validation of Navitas's Gallium Nitride and silicon carbide technology at the highest level of the silicon food chain. If you have been treating this stock like a small cap player in the phone charger market, you are using an outdated playbook. The reality is that Navitas is being woven into the literal power infrastructure of the global AI factory build-out. This partnership shifts them from being an alternative component maker to an essential piece of the most important hardware ecosystem on the planet today. The general expectation for Navitas throughout much of late 2025 was one of caution. The market narrative was that while their chips were efficient, they were losing the battle for scale against massive incumbents like Texas Instruments or ON Semiconductor. Many investors on platforms like Robinhood or SoFi Invest were worried that the company would simply run out of cash before its high-power designs could reach mass production. The common belief was that the decline in their legacy mobile and consumer revenue was a sign of a failing business. However, the contrarian reality, the Navitas 2.0 strategy, is that management is intentionally walking away from those lower-margin, high-volume consumer contracts to clear the deck for the high-power, high-margin AI and infrastructure markets. They are trading quantity for quality, and the Navitas partnership is the first major proof that this gamble is paying off. Looking at the recent trading activity, the volume on Friday was over 28 million shares, which is nearly double the average daily volume we've seen over the last 3 months. When you see a stock gap up 9% on massive volume, it usually indicates that the big money is finally convinced. Institutional ownership is currently hovering around 43%, with major players like Vanguard and BlackRock increasing their stakes in the most recent filings. For someone using an individual brokerage at Fidelity or managing their own online investing through the Interactive Brokers platform, this institutional support provides a level of confidence that was missing 6 months ago. The stock is currently trading well above its 50-day moving average of $8.49 USD, signaling a strong upward trend that could test the $12 resistance level in the very near future. But why does this gallium nitride and silicon carbide technology actually matter? To understand the valuation of Navitas, you have to look at the physics of power. Traditional silicon-based power chips are reaching their thermal limits. As data centers pack more GPUs into smaller spaces, the heat and energy loss become unmanageable. Navitas's GaNFast and GenSiC products can handle higher voltages with far less heat, allowing for power supplies that are up to 3 times more powerful while being half the size. For companies building AI clusters, this means they can fit more compute power into the same physical space. If you are using Schwab Intelligent Portfolios or a SoFi Robo-Advisor, you might not see these technical details, but they are the engine driving the stock's 200% return over the past 12 months. The business model has radically shifted. In their earlier days, Navitas was focused on the 240 million units they shipped for mobile fast chargers. That was a good business, but it was a commodity business. Today, their design win backlog has reached an estimated $450 million, with the fastest growth coming from the electric vehicle and data center segments. They have established dedicated application design centers that work as joint labs with their customers, effectively becoming an extension of their clients' engineering teams. This sticky relationship makes it much harder for a competitor to swoop in and steal a contract based on price alone. When you are integrated into the 800-volt architecture of an AI server, you aren't just a vendor, you are a partner. There is, of course, a tension between this optimistic vision and the financial reality of the present. Navitas is not yet profitable. In their last report, they showed a negative net margin, which is the primary reason why short interest is still sitting around 3.8% of the float. The market expects a loss of roughly 19 cents per share for the 2026 fiscal year. For those who are self-investing and using platforms like SoFi or the Robinhood app, this is the risk you have to weigh. Are you willing to bank on the future revenue of the AI data center pivot, or are you spooked by the current lack of earnings? The reality is that the company just raised $100 million through a private placement of common stock, which gives them a massive cash cushion of over $150 million. They have zero long-term debt. This is a rare combination for a growth-stage semiconductor company and suggests they have enough runway to reach profitability without needing to dilute shareholders again in the next year. The competitive landscape is where the real pressure lies. Navitas isn't the only one chasing the GaN and SiC prize. Wolfspeed is spending billions on a new fab in Mohawk Valley, and ON Semiconductor is aggressively expanding its own SiC portfolio. The expectation is that these larger companies will eventually crush Navitas through sheer manufacturing scale. However, the reality is that Navitas is a pure-play company. Unlike the giants, they don't have to worry about maintaining legacy silicon factories. They can focus 100% of their R&D budget on these next-generation materials. This focus allowed them to beat the giants to the punch with their 3300-volt and 2300-volt silicon carbide products, which are now being sampled for grid and energy storage applications. I want to hear from the community on this one. Comment below with how many shares of Navitas stock you are currently holding in your individual brokerage account, and let me know if you think the NVIDIA partnership is a permanent moat or just a temporary boast. Do you think the shift away from the mobile charger market was a smart move, or should they have kept that high-volume revenue stream while they built the AI side? Your feedback is essential for understanding how the retail crowd is perceiving this Navitas 2.0 transition. As we look toward the future, there are several catalysts that could move the stock significantly. The next big date is February 23, 2026, when the company is estimated to report its fourth quarter and full year 2025. The market will be looking for two things: progress on the gross margin, which sat around 38.7% late last year, and specific guidance for the first half of 2026. If management can prove that the inventory corrections in the EV and solar sectors have finally bottomed out, the stock could easily push through the $13 analyst price targets. On the flip side, if the consumer segment continues to drag down the overall revenue faster than the AI segment can pick it up, we might see the stock retest its 200-day moving average near $8.22 USD. Online investing in a niche semiconductor player requires a deep understanding of the global supply chain. Navitas has recently expanded its distribution network through a strategic partnership with Avnet and a move into the Indian market with Cyient Semiconductors. This global footprint is designed to reduce their dependence on any single region and to capture the massive growth expected in the AI-enabled mobility and industrial sectors. For those seeking investment help or exploring investing sites, the key is to watch the design win conversions. A design win is just a promise. The revenue only shows up when the product is actually manufactured and sold. The $450 million backlog is the potential energy. The 2026 earnings will be the kinetic energy. If you are managing your own portfolio on the Interactive Brokers trading platform or using a Fidelity brokerage account, you should also be aware of the geopolitical premium. Because Navitas is a US-based company with a heavy manufacturing presence in Taiwan and China, it is sensitive to any shifts in trade policy. Their recent technology and foundry partnership with Global Foundries in New York is a strategic move to insulate themselves from these risks by expanding their US-based capacity for advanced GaN technology. This is the kind of boring operational detail that actually determines the long-term survival of a chip company in the 2026 landscape. The contrast between the hype surrounding AI and the reality of a chip company's P&L is where most investors get lost. With Navitas, the hype is currently supported by a very tangible relationship with the most important company in the world right now, NVIDIA. The reality of declining near-term revenue is the price of